Hello, everyone. Today, I'm going to share with you about the tax treaty misconception. As an international tax practitioner for the last 15 years, I often heard from US expats that they believe they are exempt in US tax compliance because there is a tax treaty between the United States and the country they are currently residing. This tax treaty myth is perhaps the most dangerous for US expats because it feels logically sound, but is legally undermined by a single paragraph found in nearly every US tax treaty, the paragraph of the saving clause. Here's the myth. The treaty says I'm not taxable. The logic: the US and country X have a tax treaty to prevent double taxation. The treaty says my pension or salary is only taxable in the country where I live. Therefore, I don't owe the US anything, and I don't need to be filing. But here's the reality. While the treaty does say that for residents of those countries, it almost never applies to US citizens due to the saving clause paragraph that I mentioned earlier on. Okay? So, what is the saving clause? This is the ultimate gotcha. So, here's what happened. Most people read the first few pages of a tax treaty, see a benefit, and stop there. However, usually in Article 1 or 4, depending on what tax treaty you're looking at, the US inserts a saving clause. And the saving clause states that notwithstanding any provision of this convention, a contracting state may tax its residents and its citizens as if this convention had not come into effect. What does that mean in layman's terms? It means that the US reserves the right to tax its citizens under US domestic law, regardless of what the rest of the treaty says. Again, in layman's terms, the US reserves the right to tax its citizens as if the treaty did not exist. So here are the common treaty misconceptions. The misconceptions in relation to Social Security and pensions. Many expats believe their foreign pension is tax exempt in the US because of a treaty. While some treaties, like the United Kingdom or Canada, have specific exceptions to the saving clause for pensions, many of the tax treaty countries do not. Without a specific exception, your foreign pension is fully taxable in the US. There's also the tie break rule misconception. Expats often hear about tiebreaker rules that let you claim residency in a foreign country for tax purposes. While true, if a US citizen uses a tiebreaker to be treated as a non-resident of the US, they must file Form 8833. 8833 is the treaty-based return position disclosure. It's a treaty-based return position disclosure. Doing this incorrectly can trigger expatriation tax rules, effectively treating you as if you gave up your citizenship. So what does this mean? Be very careful when you are claiming a tiebreaker rule using a Form 8833, claiming you to be treated as a non-resident of the US, because if this is incorrectly done, it can trigger an expatriation tax rules that can be costly. Another misconception is about state taxes. Remember that the treaty between the two countries are done in a federal level, at a federal level. So you have to be making sure that if you are residing on a state, in one of the states in the United States, if that state is specifically is honoring or recognizing the federal tax treaties. Because most US states, like California, for example, does not recognize federal tax treaties. So even if a treaty protects you from federal tax, your sticky home state might still demand its cut on your foreign income. So you might be asking, what then that treaty actually does? If the saving clause undoes the treaty for citizens, what is the treaty for? Well, the purpose of the treaty is to prevent double taxation, allocate taxing rights. Which country taxes what? It reduces withholding taxes, and it provides tiebreaker rules for consistency. But treaties do not eliminate reporting obligations. So what does it mean for expats then? The tax treaty is a tool for relief, not a ticket for non-filing. You still have to file your US return, report the income, and then use the treaty rules to claim the credits or exemptions available. Okay? So, but the bottom line, never assume a treaty exempts you from filing. In the eyes of the Internal Revenue Service, the treaty usually only decides which country gets paid first, not that you don't have to report to the US. If you want clarity on your specific situation, please email hello@usautax.com to book a short call with me. Please note, this video is for educational purposes only. This is not intended as a tax legal advice or used in avoiding IRS penalties. There is no professional client relationship is established while you're watching this video. Please consult a tax professional for your specific facts. Thank you.